while everyone's getting settled in, I will do all of the housekeeping items for the day. So first of all, thank you all for coming. I'm Chelsea Scarlett. For those who don't know, I'm the marketing and communications manager here at Aintree. So I'm the one that inundates your inbox with event invitations and all sorts of nice things. But yeah, thank you all so much for coming today. We know that it can be tricky to coordinate within a workday. And we just really appreciate having a room full of people here investing in their financial future and empowerment. It's really, really beautiful to see. Before we begin officially, I just want to acknowledge the Wurundjeri Woi people of the Kulin Nation as the traditional owners and original custodians of the land on which this office stands and on which we're gathered today. And on behalf of Age Group, I'd like to extend our respect to their elders past and present, and also to any First Nations people who may be in the room with us today. For those who haven't connected with Aintree Group before, I think there might be a couple of you in the room. I thought I would just briefly share a little bit about who we are and what we're all about. So in a nutshell, we're an integrated professional services firm. So we provide support and advice across accounting, legal, wealth, finance and business advisory. So we offer all of that under the one roof. And at the end of the day, our purpose, the reason we exist, is to help you sleep well at night. And as what we call our core values of being courageous custodians of our community, what we're doing here today is a huge part of that. And it's really important to us to be able to extend our support and our advice out into our client base, but also beyond that into the local community as well. Community education and empowerment is really, really important to us as a business, to Andrew and Shane as our founders, and we strongly believe that quality financial advice should not be hidden behind a paywall. So that's why events like this that are free and are open to the community are really, really important to us. And having people come and support these events like you are just makes that so much easier, and it really brings us a lot of joy to be able to engage with the community in that way. As you might be aware, next week is International Women's Day, so that's now a pretty, I would say, well-known date on the annual calendar. There's a lot of events, there's a lot of seminars and things that happen every year. We try and get in beforehand because we know that next week gets a little bit crazy because everyone gets invited to so many things, which is great to see. But we try not to fill everyone's calendar up too much. But we just want to take this as a reminder that this day is more than sort of a celebration or like a checkbox. It is ultimately a call to action. So the 2026 International Women's Day theme is Give to Gain. So each year they nominate a different theme. So Give to Gain recognises that when we give knowledge and support and opportunity to women, we create stronger outcomes, not only for individuals, but also for businesses, families, workplaces, and regardless of gender, if you're uplifting and supporting women, you're uplifting and supporting everyone. So we've brought all of you here today with the simple purpose to share some clear, practical and actionable financial knowledge, which you can then take away, and the benefit will, as I said, benefit everyone. Financial empowerment is one of the most practical and powerful ways that we can give to gain in line with that theme. And when women build financial confidence, clarity and independence, like I said, that impact flows outwards, particularly into families, households, next generations, workplaces and things like that. I will say up front that we have put this presentation together with women and female identifying people in mind. However, the principles and strategies and everything we're going to discuss is applicable to everyone, and it benefits everyone regardless of gender. So it's really important to us that everyone is part of these conversations regardless of gender. That is also why we've got Shane up here as well, as a very strong ally to female financial empowerment and literacy. So when we refer to female specific statistics or experiences, it's just to highlight why events like this are important and why these conversations matter. It is not designed to exclude anyone in the room who may not identify with those statistics. So thank you all in the room for being part of this important conversation, regardless of lived experience and gender. before I hand over, final little bit from me before you don't have to listen to me anymore. I'll talk together.
We're all happy to listen to Chelsea, so it's fun.
The bathrooms are out in the hallway. There's some signage there, but you head down past our wonderful, beautiful big lounge area and around the corner to that back corner of the office. We've got some signs set up along the way. If you get stuck, find a team member, just say where are the bathrooms and they'll happily locate them for you. Like I said before, please still enjoy the refreshments during the session. Don't feel that you have to sit here and not move. If you would like a tea or another snack, please jump in. We also encourage questions throughout the session. I know we were talking about audience participation in the front row before. It is not compulsory, but we would love for people to jump in. The more that you ask questions, get involved in the discussion, the more benefit you get out of this experience. We've provided some notepads if you want to jot anything down, but we will be sending the slides to everyone after the session, so don't feel like you have to really furiously write down every single little thing. So now it is officially time to pass over to our wonderful panel for today, as Shane's phone goes off. So our panel today is our CEO, Andrea McKenna, and our Managing Director, Shane McKenna. They are both experienced business advisors and keynote speakers, and they started Aintree Group together as a husband and wife team over 21 years ago. They've supported and advised hundreds of people through a wide range of financial challenges, and that experience informs so much of the presentation today. So please tap into that wealth of knowledge and experience as much as you can. And without further ado, over to you.
Thank you, Chelsea. I have notes because my brain is over 50, and anybody in the room who is over 50 understands that brain fog is a real thing. And I say this to my team all the time. There's nothing, we have to be honest and open with each other about all stages of our lives. And sometimes it's harder to remember things than others. So forgive me if I read off notes at some point. Shane never reads off notes. He is not that way inclined. So I'll have my notes and I'll refer to him. One of the first things that I would like to do in today's presentation is to acknowledge Chelsea and Laura and the vast amount of work that they have done to get everybody in the room today. Putting together an event like this is no small feat, particularly in the vastly busy lives that we all have, and it's so wonderful to see you all in the room, and I thank them deeply for the amount of work that they put into making sure that we're all fed and watered and beautifully presented food, so thank you to you both. There are a number of Aintree Group team members in the room today who can answer any of your questions. It's not just Shane and I. The wall along there is all Aintree Group. I'm not sure why they've all sat along the wall, but they all have, ranging from our amazing operations team members to some of our highly technically skilled accountants. They will be able to answer any of your questions. And thank you so much to Peter Gandolfo, who has also joined us in the room for a little bit of legal knowledge. So Shane thinks of himself as a bush lawyer, but we actually have a real lawyer in the room. So amazing to have Peter here today, and Peter has brought some of his friends along with him today as well, and I appreciate their coming. Today's presentation is about building confidence and independence. It is not about telling you what you have to do. Everything that we talk about today is general advice only. Nothing is specific in circumstance. Sometimes you might ask a question that is specific to you, and that's okay. But anything that we go through here may not have any impact on you. It may not be your personal circumstance. It's really important that you seek out advice that is specific to your circumstances. And one of the key pillars of this sort of presentation, we've done it a few times in a few different variations, is that as women, we typically are the ones who take a backseat to financial advice and legal advice. We will often defer to our fathers, our uncles, our partners if we get them, and we will take a bit of a step back. I'll be perfectly honest with everybody in the room. I have, because I have a chartered accountant as a husband, so I don't actually have to think much about all of those things. But that doesn't mean that we shouldn't be involved and we shouldn't sit at the table, because there are conversations that we can add value to in every single way. So please make sure that while you may be in a situation where you have someone in your life who is incredibly skilled in that, that doesn't mean that you should not value your voice and have a seat at that table. So please make sure that you do. At Aintree Group, across the board, and some of our best female allies at Aintree Group are men. You know, we've got Peter in the room, we've got Shane in the room, our wealth director is James. All three of them have been in situations where they have advocated very, very strongly for the women in circumstances. So they know what it is to be in those spaces and to make sure that they are caring for the women in those situations. Divorce situations, business issues that have gone through, and we have sat at the table for those women. So even though they may not directly be impacted by some of the things that we're talking about today, they have stood in place of people and supported them. So it's also important in International Women's Day to understand that there are men out there who are very safe spaces for women. So we believe that financial empowerment is not about becoming wealthy for the sake of status. It's not actually about wealth. It's about protection. It's about being courageous. It's about taking decisions in informed ways for ourselves, so that you're never financially vulnerable due to your lack of knowledge. Sometimes you may be financially vulnerable. It's not because of you not knowing what you're supposed to be doing. You know, that's really important. Financial independence to us means that you can understand your own financial position, you can make informed decisions, you're not reliant on someone else to interpret those finances for you, and you're prepared for change. Life changes, relationship changes, income changes, health changes, all of that sort of stuff. Preparation reduces fear. So the more knowledge you have and the more you are prepared for those things, the better you will manage them as you go forward. Just a quick show of hands, and you do not need to put your hand up. It is an optional thing for you to do. Who in the room feels like they are completely across all of their financial circumstances from a legal and finance perspective? Yeah. I think we can all see that it's pretty few and far between. Like, we're probably not all where we could be. That's okay. There's no right or wrong for this either. It is what it is. What this session is about is making sure that you have access to the information that you need to in the future. And the fact that you're sitting in this room puts you ahead of a lot of other people who are not in the same sort of situation. Here's our general advice only disclaimer. I have to put that in. Peter's in the room, so he will want to make sure that we've got it. General advice only. Please seek advice. There are people in the room who can help you if you have a question today, and we are more than happy to answer questions or make a time for you later on down the track if you don't want to ask those questions today. It doesn't matter if it's us. Seek out personalised advice before implementing any structural changes in your circumstances, whether that is us or whether that is another qualified and trusted advisor. There are many out there, and we can give you access to our network as well. So just because we do everything in this room doesn't mean that we think that we are for everybody. Sometimes we need to find you someone else, and we have a big network of people who can do that. Chelsea's done a bit about who we are, so I won't waste any time on that. We've been in business together for 21 years, and we have been through almost all of the situations that we will talk about, or we have supported family or friends who have been in these situations. So again, there's not much that you can ask us that we will go, oh, I've never come across that before. So what we'll cover today, so I think we've been through this part as well. Clarity, so that you can understand your own individual financial position. Protection, so that you can have a good understanding of what your expectations should be when you are entering into a relationship or exiting a relationship or some other sort of change. And then growth, maintaining independence by intentionally building your own wealth over time. And it's not about being rich and being able to do these. Lisa's nodding furiously. It's about being in a position where you feel safe and comfortable and that you can move forward with your life in a happy and positive way. Okay, this is where we start to get into the super, super interesting stuff. And we've all heard this before. We know that the Australian gender pay gap sits at around 21.8%. That means that women who are doing the same job as men are being paid roughly on average 21% less than those men. I am very happy and very comfortable to say that that is not the case in this business. It is a very conscious decision that we are very open and transparent about those sorts of things, that we do not have that gap. So yeah, well done to us. I'll pat myself on the back there. Women retire with around 20 to 25% less super than men do, and yet they live on average 4 to 5 years longer. So women often face challenges when managing their money. Career breaks for caregiving, we all know that for the most part, women are the ones who take time out of their working career to look after children as they grow. They are also typically the ones who are looking after elderly parents when those elderly parents start to need more support. And so there is a huge time in life that you go through it when you are younger and you're having your babies, and then sometimes you're going through it again later on in life when you're trying to get yourself into a situation where you may be looking to retire or finish up full-time work and things like that. And all of these things have an impact on how quickly we are able to do those things and how we can move forward with our plans. So it's also really important to understand that women aged over 55 are one of the fastest growing demographics at risk of homelessness in this country, which I think that just gave me goosebumps. I don't know about anybody else in this room, but that is actually really something that we need to be more aware of, that there are more women living in their cars at the age of 55 than there ever has been in the past, and that is a real slap in the face, I think, as a society like ours. So talked about the structural reasons. Sorry, I've got my notes in front of me, but I'm not referring to them word for word. We're not highlighting these statistics to create any fear. We're just highlighting them to create awareness. There will be people that you come across in your book club groups, in your workplaces, in your networking events, who may be at real risk of homelessness or retiring or having to retire early or things like that without having a financial safety net, without having insurances in place, all of those sorts of things. The more we are aware and the more we talk about them to each other as women and not be scared or frightened of those conversations, and the more we're actually willing to put our hands up and say, I need support, because we're really bad at that as well, about saying to each other and to our girlfriends, I need you, I'm going to need more from you, and things like that. The more we do that, the better. The more we understand that we need to support our aging parents, the more we recognise all of these things, the better our society will be in looking after the people who need us to look after them. All of these life patterns require strategy, because if you're living longer, earning less cumulatively, then the margin for error is lower. Like you get to a certain age where you will sit down with a financial advisor and they will say to you, you don't have enough money to live off for the next however many years. So you want to get in early. You don't want to get to the age of 45 and then sit down with a financial advisor who then tells you that you should have been putting superannuation away earlier so that you've covered yourself. So these things are really important. And again, this isn't a scare tactic at all. This is so that we can all sit down and have those conversations with the people that we trust and love. We've done this presentation before in the light of talking about women's health. And that's actually the reason why I went to a session talking about women's health, and I came home back to the office and I said to Chelsea, we need to do a session about this because this is real. That session about health talked about how, women are not empowered from a health perspective. We know that. Our Prime Minister's been talking about it over the last number of days that, women go to the doctors and they're told to take a Panadol, you'll be okay. But women are often taking more personal leave than they have available to them because their health is not where it could or should be, because we're ignoring things like the detriment of endometriosis, of heavy periods, of not being able to fall pregnant, and how that is impacting on our mentality and our ability to forge forward in workplace situations. So all of these things are tied together. We can't talk about financial health without talking also about mental health and physical health, because they all combine with each other. There's some stats on there. I won't go into a lot of detail about those things, but they're all interconnected, and we need to understand that lower earnings, rising cost of living contribute to disproportionate financial strain. So those things amplify mental and physical health. If you know that you do not have enough money to pay your bills next week, then your mental and physical health is going to be impacted by that as well. So we can't just talk about it from a, as long as financially you're okay, because all of these things work together. So this is where the experts come in. This is where Shane will come in and talk about these sorts of things, because he knows all about this sort of stuff. Understanding your own financial position. Make sure you know it yourself. Understand your cash flow, tracking what comes in and goes out each month. Shane will talk about some apps that he is familiar with. I'll throw it over to you for the moment, Shane. You can chat about this stuff.
Yeah, so just to reiterate what Andrew is saying, and I deal with a lot of people every day, business owners, families. And it's really important that everyone in the family, particularly the husband and the wife or the spouses, whatever the arrangement might be, that you do understand your financial circumstances. Don't leave it to one person. But you need to understand what you're spending and what you're earning. So we've seen a lot of clients, and we've taken on a couple of clients recently who they've had no understanding of their financial circumstance at all. And we then looked at whether they're a small business owner or otherwise, they've then looked at their affairs, and they've got huge tax debts because they haven't managed it effectively, because they haven't been managing their finances effectively. They're incurring interest on loans unnecessarily because they haven't been smart about what they're doing with their money, or they've got money. I've got a client who's got quite a number of millions of dollars sitting in a bank account earning 0.1% interest on that money, when they could be earning 4.3% or something by just moving into another bank. So it's really important that you're on top of all your affairs. Also, and it's a classic one. How many subscriptions do you have to Netflix and Prime and all those sort of things?
Yeah.
So actually understanding what your outgoings are on a monthly basis is really critical to see whether things are excess to what you need, and whether you can then redeploy that money for something that's more effective for you in the long run. So some really good apps that you can use. Now, Pocketbook is no longer, Pocketbook's on there, but Pocketbook is now defunct, unfortunately. But Frollo is a really good app. What you do is you just download it on your phone, you link your bank account to it, it's all secure, and it basically tracks all your expenses. It's got AI built in. It recognises, okay, that's Netflix, so it'll allocate it to Netflix, and you can get a lovely report every month about your ins and outs for the month.
It also gives you reminders when your bills are due, right?
Yeah, correct. It does. Yeah, it does all those things as well.
Like just checking, by the way, your phone bill is due this Friday. Make sure there's enough money in here.
Yeah. So. Yeah, and it's not hard. It doesn't consume you either. It's not, oh, gee, it's like I'm doing bookkeeping and I'm spending 3 hours a month on something. It's nothing like that. It takes you probably 10 minutes to do it every month or something. But just understanding that, and then could be enlightening. You might say, oh, wow, I did not know that I'm spending so much money per month. And that gives you knowledge. And that's what the key thing with this, it's about knowledge. And then how you apply that knowledge to then get a better outcome for yourself. So simple things like that. I think it's free, isn't it, Frollo? Yeah, it's free.
Yeah.
Yep. So there might be some advertising and things on it, which is what they get the revenue, but it's a free app. If you're comfortable with linking your bank account to it, it is a simple way, and you can have multiple bank accounts as well. So credit cards, bank accounts, loans can be attached to it. I'm not getting any commission from them, by the way, so I'm not trying to sell the product to you, but something like that is really effective. Or if you want to run a spreadsheet because you love spreadsheets, that's okay too. I don't like, I'm an accountant and I don't like spreadsheets, but yeah, using apps where it does all the work for you is much better than trying to do your own spreadsheet and making sure formulas and everything work. So yeah, and know what you're worth as well. So not just what your cash flow is, but what's your asset base, what's your liabilities, more importantly, and then always interrogate those things and work out, am I getting the best deal on those things or not? So give you a quick example that, if you've got a home loan, when was the last time you had a look at what that interest rate was and benchmarked it against what's out there in the marketplace? We encourage clients to have a look at that. And if their rate is above a certain threshold, now they're changing a little bit at the moment, the rates, but get on the phone to the bank and say, look, I'm not happy with my rate. I think I can get a better deal elsewhere. 8 out of 10 times, they'll drop it by 0.5% just by you ringing them up.
You can do that the other way too with savings accounts in banks. In your bank app on your phone, you can up your interest on your savings account for like a 3-month period. And just every 3 months, I have a calendar reminder that goes off that I go in, ask more interest, do it again in 3 months.
So these are tiny things that you can do. Like one phone call might save you $5,000 or $6,000 a year in interest, subject to what your loan is. So it doesn't hurt to try. And if you try and don't get successful, that's okay. But that's then when you should look at engaging say a mortgage broker or something to have a look at that to see what the market is offering, and then you can make an assessment about whether your interest rate within that market range, or whether you need to look at refinancing to another bank to try and get a better deal. So it's always being across what's going on in your personal affairs to know what your ins and outs are on a cash flow basis, and then secondly, knowing what your commitments are in terms of loans or otherwise. And then thirdly with that, if you then find there's some savings, it's about how you use those effectively to then build wealth for yourself. And so if it's money that you don't need to day-to-day lifestyle, then look at putting that somewhere where it can be effective for you from a tax point of view and also from a wealth creation point of view. So those things are really critical to be across. And things can change, and if your circumstances change, it's okay too. You can recalibrate. The one thing I do want to make clear on this though, and I always say this to clients, is it's not about trying to rip out all the expenses and then you have this boring life where you're not enjoying it. Why do you work? Why do you create wealth? It's to enjoy it. So don't go to the extreme where you're basically sitting at home every night doing nothing because you don't want to spend money on Netflix or you don't want to spend money on whatever it might be. You've got to have, some of that money has to be for enjoyment. And that's really critical, and that leads into the personal health side of things and the mental health, because finance is only one side. The mental health and the personal health is also critical. So getting that balance right is important.
Yeah. Can you talk a little bit about the tax basics side of things and deductions? Because we see things come through, information memorandums from the ATO and stuff about what people have tried to claim, probably pushing the boundaries of what you can and can't claim. So let's just talk about that for a little bit, about what happens there.
Yeah, so obviously everyone, if they're earning income, has to lodge a tax return each year. The tax rates are really important in this too. So, and I'm not going to the full details because I could talk for the next hour and
come to Shane's tax and budget.
But basically the first 20,000 you earn on your own is tax free. Roughly, it's not quite that bigger, but there's rebates. Then the next 25,000 up to 45,000, the tax rate currently is 16%. Pull me up anyone who'll if I get this wrong. But over the next 2 years, that's going to go from 16 down to 15 down to 14%. And then the amount above 45 to 135,000 is taxed at 32%, including Medicare levy. Once you go over 135,000, then goes up to 39%. And then once you go over 190,000, or is that number changing? I can't remember. Anyway, they change the numbers so often, even I can't remember them. It's 47%. So it's really important that you understand those things. From a tax deduction point of view, if you're earning $20,000 or less, tax deduction is really not relevant because you don't get any tax benefit for them. You only get a deduction and a tax benefit based on what you're claiming based on your marginal tax rate. So if you're on that 16% tax bracket and you claim something, then you get a 16% rebate. So if you spend $100, you only get $16 back. A lot of people think, oh, I get a tax deduction, I'm getting all that back. No, you only get your percentage of your tax rate that you're on as the rebate. So don't do things just for a tax deduction, right? Because you're going to be out of pocket. So that's the first part. The second part is be careful based on what your employment income is or what your activity is that generates income. There's certain deductions you can and can't claim. I'm not going to go into all those because it's all quite interesting. There's been things where people try to claim dogs as tax deductions, and some weird and wild
Coffee machine.
coffee machines and some weird and wild
Yeah.
things. You just got to be careful of those things. If you're not sure, seek advice. Maybe don't chat GPT or anything like that, because that might not give you the right answer. But seek advice, but just be careful about your claims. The ATO does data matching now, and they can see a lot of what you're trying to claim, and then they will interrogate that through their automated systems to then get you to justify it. And if you can't, the penalties can be up to 75% of that claim that you have incorrectly claimed, or the tax on that claim. Plus, then they'll charge you interest at 10.6% on that too. So just going to be very careful with it.
The data matching thing is something that you really need to be aware of as well, because they have access to your bank account. So if you've gone to Harvey Norman and spent $695 on a coffee machine, and then you claim that in your tax as a deduction, they will be able to find out. Like, they may not, but is it worth the risk? So just be really careful and make sure that you're not claiming things just for the sake of, like, oh, I can put that through.
Sure.
There are some things that are absolutely deductible and some things that really push the boundaries, and the ATO have started to pull people up on those sorts of things. A quick chat about super contributions.
Yeah, so superannuation contributions, each person, subject to your member balance, can contribute up to $30,000 per year into superannuation and get a tax deduction for it. So if you're on a marginal tax rate of 32%, like I talked about before, if you put $1 of that into superannuation and claim a tax deduction for it, then you will save that 32 cents a dollar on your personal tax. And then the fund, when it receives that money, that dollar, it will take out 15 cents of that, paying 15%. And then the 85 cents of that will then be invested in shares or whatever you nominate with your superannuation fund. So just on the putting that $1 into super alone, I'd talk about it as a return on investment. 32 minus 15 is 17%. You're getting a 17% tax return or return on your investment by just moving that $1 from your personal name into superannuation and let them, the super fund, then invest it for you. That's before it then gets a return on investment. So then if you're in a good fund where it's returning between 8 and 10%, which is the average for some of these good funds, add that on top of that 17% benefit, you're now talking about it getting a 25% return on that $1 that you can sacrifice from Netflix or whatever it might be, or that coffee, that 2 coffees, drop it to 1. I'm not saying you do with this, but just examples. That $1 going in gives you a 17% return just on the tax, and then the investment return that goes on it. If you're in a higher bracket, if you're over 135,000 worth of income, 39 less 15 is 24 cents a dollar, just tax benefit. If you've got a super balance less than 500,000, which unfortunately a lot of women will have because they haven't had the ability to generate the superannuation contributions from their employer or otherwise, you can actually, if you've missed out on that 30,000 threshold in previous years, you can actually bring that forward and utilise prior year ones up to 5 years worth of missed contributions. So that's something to also bear in mind. The trick with all this though is that 30,000 threshold per year includes any employer contributions that you get from your employer. So if you're making voluntary contributions yourself, you've got to factor in that you've got amount from your employer, which is at 12% now. So if you go over that 30,000, you don't qualify for that bring forward, then they charge you excess contributions tax, which will be at your effective marginal tax rate. So it undoes the benefits of that contribution to super. Super is really complicated, but it's also conceptualized in terms of just putting $1 in and getting the tax benefit. That's quite simple. So every dollar you put in, and the younger you do that, the compounding impact of, one, the tax benefit up front, and then secondly, the return on investment that money will generate over 10, 20, 30 years can have a massive impact on your overall wealth. And when you retire, the age for retirement, the minimum age for retirement to access superannuation is the age of 60. And then everyone's got full access to their superannuation once you reach, if you're even working, once you reach 65. So putting that money in early, yes, you've got a competing interest. You might want to pay for the mortgage or otherwise. We've just got to find the right balance. But maybe a mix is what's appropriate. This is general advice. But every dollar into super can make a massive impact on your long-term savings, and then what you've got to then retire on comfortably can be increased dramatically.
Also, general advice: what age is too young to start putting good amounts of money into super? This does not apply to anybody in the room. This is general advice, so don't take it, but it is a real thing. Because lots of people, and I'm included, used to think, as I was, when I was younger, I don't want to put money into super. That's a waste of money. I could be doing all sorts of things with that money. People probably don't understand. Who in the room understands compounding interest? The people who have done university degrees in accounting should absolutely know. maybe just cover that, and then like what age is.
Be really nerdy. I'll be nerdy on it.
Yeah.
Sorry, and bear with me. I'll try and do this as quickly as possible.
Okay.
What roughly does anyone know what the interest rate is on a standard home loan at the moment? Roughly, anyone got an idea? Just pluck a number. 6, yeah, 6, maybe 6. It's around that number, 6%. Okay, so this competing interest between putting money into super versus paying down the mortgage. So if you put $1 into your mortgage, how much interest are you going to save? You're going to save 6%. If you put that $1 into superannuation, you're going to save, in that example I gave you before, if you're on 32% marginal tax rate, you're going to save 17%. That alone suggests, I'm not saying you go whole hog into paying off the into super, but that suggests alone that there should be a mix between the two at any age. But we've got that competing interest. The catch with super though is once you put it in, it's locked away. So if you then need to build a deposit for a house, then that could compromise you on buying a house. So there's no hard and fast rule about what you should do, but the younger you start doing the super and doing the compounding, that can have a massive impact if you've got a good fund and it's returning good investments. I'm not selling products here in terms of the funds, but just to give an example, ones like Aware and Australian Super, these industry funds, over the last 30 years have averaged 8 to 10% returns. All right, that return alone by having that money in super and invested effectively is higher than your interest rate on your mortgage. So just finding the balance between the two. But if you're trying to save for a house or trying to save for a marriage or whatever it might be, then you've got to then obviously then just prioritize what you want to do. But there's no harm in doing something for a little while, then changing it. You can change it anytime. Yeah, but certainly superannuation is the last bastion of low tax vehicles in Australia. You probably heard about capital gains taxes on the chopping block at the moment, or it's going to be changed. So this is one area where there can be significant benefits long term. So it's a patient long term strategy. It's not a short term gain for you, but certainly my take is that the earlier you can get at least a little bit into super, even if it's only $1,000 a year or 2,000, if you look at the compounding effect on that over 10, 20 years.
Explain that.
That alone can be
effect for the.
Basically, the old rule of thumb used to be you double your money every 7 years. So if you put 10,000 in this year, in 10 years time, that'll be worth 20. In another 7 years, 7 years time will be 20. Another 7 years time will be 40. Another 7 years time will be 80. So you can see now that's based on traditional things, but if you're getting that 8% return, that generally means you're doubling your money every 7 years roughly because of the adding that and compounding. So you can see how that small amount now can mean when you're age 60. So someone like you, Alana, who's young, who's a baby, putting a little bit in, the compounding effect on that can be quite substantial. Yep. And it's not too late. Even if you're at 45 or 50 or whatever the number is, and you've got a balance below 50, we can catch up superannuation if you've got the cash flow available to be able to do it. It does require cash flow and careful management of that.
Yeah. And I think the bottom line on all of that is make sure that you are involved in financial meetings.
Yeah.
Like, don't sit out of them. Don't think that it's something that you don't need to do on a yearly basis. Some of you will not, have your tax done by anyone other than maybe a simple H&R Block sort of service. Go in and ask them questions. Don't just try and run through it and hope for the best, because there will be things that you can do along the way. And if you don't have access to a good quality financial advisor, there are so many really good women advisors out there who have Facebook and Instagram profiles where they give really good advice, and they sometimes have mentoring situations that you can sign up for as well. I went to one last year where the lady was, she's an accountant, and she's decided that she's going to focus on women building wealth. Her name is Mel Brown. She does online webinars. She does all sorts of amazing stuff. It's really good to get access to this information. No sell with those sorts of women either. They're just purely giving you information and ideas. You can sign up for the mentoring program if you're wanting some accountability, but she's not selling you products. So that's a good one. And we will email all of that sort of stuff out to you later on anyway, so that's fine. Yeah, go ahead.
Oh, yes, sorry. Oh, yes. It's a really interesting one. So if you're going through, if you get married, there's no tax implications on that alone, because marriage does not trigger a tax event in any form. But the key thing with that is about then if you're in a de facto relationship or otherwise, and then you have a marriage breakdown down the track, then the assets that have been brought to the marriage, it's about how they're dealt with between the parties. And we've got situations where one party in the marriage might be bringing substantial assets, another one not so substantial assets. It's about how all that is managed in a relationship, but ultimately, if you divorce or pass away, they're the two trigger points really where tax comes into it. So if you divorce, again, there's no trigger at that point on tax. But what it means is when the assets are split under a binding financial agreement or a court order, there could be potentially underlying unrealized tax liabilities on the assets that are split between the members. And that's something that's really important to be factored into any split of assets between partners, because if one person takes cash and another person takes property, and that property's gone up in values quite substantially, when that person who took the property sells that property, there's inherently a tax liability that's sitting on that property. So making sure that we're factoring the tax consequences of assets on a marriage breakdown is really critical. The same goes with, I could talk about this one for 2 hours as well. The same goes with inheritances. So the actual receiving, someone passing away, the assets transferring to the beneficiary of that estate, again, doesn't necessarily trigger a tax liability at that point. It's about what that person then does with that asset. And then when they sell it, that could, again, like that marriage breakdown one, could trigger a tax liability that wasn't factored into when the inheritances was calculated. So what we always do when we're advising people on marriage breakdown or also inheritances, we want to factor in what that potential tax liability is, and we need to equalise the accounts or adjust the allocations of assets between the parties to ensure that that tax liability is not being borne by one person unfairly over the other. And unfortunately, in these things, and I'll be honest with you, going through marriage breakdowns, it's generally the male who controls this process, and the wife unfortunately doesn't get the right advice, and they can sometimes be left with a liability they weren't prepared for or understanding of. So it's really important that that's open and transparent, and each party is getting the right advice to make sure we're factoring that tax liability. Yep, does that answer it? Sort of, kind of.
From a younger perspective and less technical perspective, just basic stuff though about some people I think don't realize when you get married, each other's income, you have to give their income when you do your tax return.
Yeah,
so there has to be a level of transparency between you. So when you do your tax return, if you're married, you have to put in their income and
or de facto as well.
Or de facto as well. You don't even have to be married, just living together. And then also it can impact things like the extra Medicare levy
private
and stuff.
Health insurance.
Private health. So I had a situation where I had paid for private health, and at the end of the year I went to do my tax return, and I was all excited because I wasn't going to have to pay the levy, and then I found out that I still had to pay the levy because my husband didn't have private health. So keep that in mind, that it's a joint thing that you're both coming into, and you have to be a bit transparent about.
That's right. Yeah, there's certain parts of the tax system where they calculate based on family income or husband and wife income or partner, spouse income, the same sex, whatever the case is, but they combine the income for working out private health insurance rebates, Medicare levy potential reductions, and there's a few other ones as well that they take into consideration. Yeah.
Just on that, because it's an important thing that we've just talked about, superannuation. When you marry and you decide to have a family and you take time, and I say you as in the women, young women in the room, and you decide to take time off work, what do you think at that point happens to your superannuation? Your contributions stop, right? Because you are not working anymore. What often happens is that women completely ignore that. It's like, oh, well, whatever, doesn't matter. At that point, you should be saying to your partner in the conversation, well, my superannuation contributions, employer contributions have stopped, but that doesn't mean that I'm not making a contribution to our circumstances. So how are we going to equalize this? Because this is one thing that happens when, particularly down the track, if worse comes to worse and we're divorcing, your superannuation balance is much lower than what it potentially would have been if you hadn't have taken those 5 years off work to look after your kids, or however the case may be. So really important to have those conversations up front about what your expectations are as you're going into a relationship, and whether you're going to be the primary caregiver, and in which case, there has to be some, cognizant conversation around those things, because for the most part, those conversations don't happen, and we see it often.
Do I talk about wills very quickly and stuff now, or is that down there?
There's a will
Okay, sorry.
section, so
Yeah, sorry.
yeah, we'll talk about that.
Sorry.
Yeah. Did we cover off any other questions? You can ask questions after as well. There's many technical people in the room. So we've talked a little bit about this part, and Shane and I are not the financial advisors in our business, but James is. So if anybody needs some financial advice, then we're certainly happy to go and drag James into the room so that you can have a chat later. But just some stats for everybody to understand as well. There's research to show that women are strong investors. They are very good, they are very discerning, they're very calm and very capable. They just don't do it often. The research shows that when women are in control of their financial investments, that they make really strong decisions and they have really good judgment. They don't do things like emotionally. There's a whole thing that women make emotional decisions and all of that sort of stuff. It's not true. They are less emotional when they make decisions.
Men are the ones that make the emotional
exactly.
from a mate.
Yeah.
Says, oh, this is how good I'm
Yeah,
doing.
yeah. My mate made as much money.
Hey, look what I'm doing.
Yeah.
So they'll jump in without having any research and then make it lots of.
And they'll call Shane and they'll say, oh, my mate down the pub, so I've just put 30 grand into this, and Shane's like, really, what? Whereas women would never do that. I mean, we may go and buy a bag that is more expensive than what we wanted to, but we've got something physically for that. So, but we make really good decisions. We just don't give ourselves a voice or sit at the table when it comes time. So seeking out the information and understanding as much as you can is really important. And trust your instinct, because you have really good instincts. Women are shown to have really great instincts. So change your thinking from I'm not good at it, or, I'm not really interested in it, or my partner is interested in it, or, whatever the case may be, to I'm not quite as sure of it as what I could be, and find yourself some information around that. Talking to a financial advisor, signing up to accessible investment platforms. There are some really easy, low stress ways.
My little favorite one.
Raises on them. So there are some easy ways to test yourself with investment strategies, having a bit of fun with things, as these products can be a little gamified, but also Raise is one where you can ask it to, like, if you go and buy a coffee every day, it'll put the balance of whatever the coffee, like $5.80, it'll and so you're contributing to your investment strategy without having to make too many actual decisions. But you can with these platforms as well. You can move it around to your personal circumstances and your risk appetite. But if you're an unfamiliar investor, these are really good ways to do this, particularly for young people. So if any of you in the room have young people in your lives who are looking to start, they're starting to work and they're looking to put, $1,000 here or whatever, small amounts that they can start to feel comfortable or learn from, these are really good platforms to be able to use, and very reputable. So I know they're online and sometimes people feel uncomfortable with setting up their info on an app and stuff, but they are backed. They're secure.
The Raise one's pretty cool. Again, I'm not selling the product, but I've got my children on so they can start learning about how investment works. But one of the things that's so, as Andrew said, if you go and buy a coffee for $5.80, might be wrong on the price. I don't drink coffee.
You buy me coffee every morning.
You said it, I do, yeah. So $6.10.
Yeah.
So $6.10. So I can set it so that it rounds it up to $7.90 goes straight into the Raise account, the investment account. And the good thing about it too, what it does now is that you can actually direct that straight into a Raise superannuation fund. So it goes into super. So again, then you get that tax deduction that we're talking about. So, and it's those little tiny things you don't notice. That can build up, and so every month it might be that you ultimately get $40 or $50 worth of, because every transaction is rounded up, you might have $40 or $50 that goes into your investment account, and then that's starting to work for you. Now you can, and same deal. You can then do a recurring payment that comes out as well. So you can do all those things within these apps now, and it's really, really effective. But also good for young children to, if they're 18 or even younger, that just you can do it in your account and have a kid's account under yours. and you can get them to start, and then they can watch how, you know, they can see the fluctuations and how the investment world works, because financial literacy, not just for women, but for children, is really important. And we want to try and educate them as much as possible at a young age, so they're disciplined and they're on the right path from day one, and they're not, you know, because they want to live and enjoy their life, and they think that credit cards sometimes is just an endless supply of money. So educating them early is really important. It's called RAISE. So the first one, RAIZ, that's just one of them. There's Commonwealth Bank has one built in as well. So if you've got Commonwealth Bank, there's actually got the same sort of thing. They also can create buckets. I don't know if everyone knows about the Barefoot Investor and Scott Pape. They've got the same thing. You can have buckets. So you can put money into different buckets for different purposes as well within the investment vehicle. So it's still invested for you, but it's in that you can put a holiday account, you can put a everyday account, whatever you want to do, kitchen renovation account, whatever. But they're really intuitive now, and it's just about then still getting the right investment mix for you, whether what your profile is, and you can also pick your independent stocks if you want to too. So if you think Commonwealth Bank, just we said that before, is going to keep going gangbusters like it is at the moment, then you might say, I want to put a certain amount of that into that. Or if you want to dabble in cryptocurrency, you can also buy into Bitcoin with it. So you're not going straight into yourself, but you're using a platform to be able to have a little bit of a dabble in that if that's something of interest to you as well. The whole logic of all these things is for long-term growth, though. It's not for short-term fix. If you're going to put in there and then pull it out in 3 months' time, it's not the right thing. It's got to stay in there and it's got to work itself in that account to build that return. But it will go up and down, and it's a good way to educate yourself on how volatile the markets can be, and be patient with the markets too. Sometimes there's big corrections down. That's not the right time to sell. You've got to hang in there. If you can hang in there, you hang in there, because over the long term, investments generally will go that way. Some won't, but if you've got a good mix and got spreading your risk, in the long term, it should be a good return for you. Can I say one last thing? Because covering just with financial planning, one of the really important things I think that people do, we talked about follow before about knowing what your ins and outs are. One of the things that financial planners should be doing is doing a cash flow forecast for you. So they sit down with you, ask what your ins and outs are. So one, you need to know that to start with. But then based on those ins and outs and based on your current salary, they can then map out what your net wealth looks like now out to retirement age or whatever it might be. And then they can throw elements in. So James does this quite actively with our clients, and he'll say, okay, based on your current circumstances, based on your current income, and based on this average return that we should be able to get on your investments, this is what your path looks like from here until age of retirement or a certain date you want to nominate. And then you say, okay, I want to go on a holiday in 3 years' time, so let's put that amount in there. Let's see what that does. And you can say, okay, my children, I'm going to stop paying school fees in 3 years' time. We put that in, then recalibrate and see what happens. So it gives you a perspective on what your end game might look like. And that might be just enough for you to then understand about where you're at. But then the next conversation could be after that. Once I know that, what do I need to do to get to an amount that I want comfortably to be able to retire on and not worry about running out of money? And I think that's something, I'm not trying to sell James, so that's something everyone should do. And then the accountability for that is the next part, where you catch up once, twice a year to review and assess how you're going against that plan or that model, to ensure that you're on track or not. And if not, what do we need to recalibrate? Do we need to cancel that Netflix subscription and just try and save a bit more money here? Because we're not going to get to where we want to. But even a small amount like, $30 a month or whatever can have a massive impact on your overall return if you do that early. So yeah, I'm not saying cancel your Netflix because it's got some good shows on it, but just be mindful of those things.
I think the important part here as well is that financial advisors don't necessarily have a good reputation in terms of the trusted advisor. Your financial advisor, regardless of who they are, number one, you should trust them implicitly, but number two, financial advisors are not just there to sell you product. It's really important to understand that. A good financial advisor will not be selling you product. They will be taking you through that cash flow process and having a good conversation with you on a yearly basis about understanding where your circumstances are right now, and they will be able to help you plan for the future. So don't think of it as a really negative thing like, oh, I'm going to go to a financial advisor and they're going to sell me a managed fund or an investment strategy or whatever. A good financial advisor is going to give you personal circumstances advice, and they're going to sit down with you. I know Shane has talked about how James does it. There's a reason why we chose James to be our Aintree Group Wealth Director, and it's because of the way he does this work. He really focuses on it, and we've had situations where people have sat down with James and understood that, yeah, we're good. Everything's fine. I'm comfortable, and I'm going to be happy until I get to 85. And then we've had some others who have sat down with James and said, well, we are in a spot of bother, and he will work actively with those people to help them recalibrate their situation. So that's what you should be getting from your financial advisor, and it's really important to do that sort of stuff. All right, retirement planning. This will go through this reasonably quickly because lots of the people in our room are not at retirement age. So what does your ideal 60 plus look like? That is ultimately where you need to start with a conversation. And that means you start with a conversation with yourself. What does it look like at 60 for you? Where do you want to be, whether you are in a relationship or not? Start with where do you want to be? And then broaden the conversation after you've worked that out. Because I think women typically don't have those conversations with themselves very well. Will you be helping your adult children? I can say to you safely, yes. Lisa's nodding again. We will, if you've got adult children, you'll be helping them, whether it be looking after their kids for them because they're working, all sorts of situations like that. Will you be downsizing your home? What does that look like? And, what is that going to cost? What does that look like for you? Will you still be working part-time? Will you be doing volunteering or charity work? Will you be supporting aging parents? All of those things are really important questions to ask yourself as you are thinking about what your 60 plus looks like. Many women in Victoria are asset rich but superannuation poor. We've talked about that, and that's as a result of many factors, but taking time to take out of the workforce to take care of children is something that is real for women. The fact that they do not have a lot in their super does put them at risk of financial instability in later years. It's why we're seeing the 55 plus age group in a homelessness situation, because they haven't been able to get themselves into a comfortable situation. Retirement standards, you need to understand. This is one of the things that James does really well. He will tell you what you need to retire when you're retiring. So that's a really good number to put a figure on. You can safely assume that it'll be more than what you think it might be. So think about it from that perspective as well. And the age pension alone currently provides around 29 to 43,000 per year, depending on your circumstances. Those circumstances change depending on what your asset situation looks like, and that is a conversation that you will have with your financial advisor and your accountant, because there is no single rule for those sorts of things. It's very, very complicated. There's what we've already talked about as well. You should not be depending on your partner having a lot in their super. That is a conversation that you need to have well before it becomes I'm going to retire. You need to talk about that. I'll be getting a big inheritance from my family. I'll be fine. There's a lot of hopium around that sort of stuff. We actually actively tell parents in conversations to enjoy their life and go out and make sure that they are not spending their final years not spending money because they want to give to their children. We also have active conversations with parents who have wealth invested to give that to their children while they are alive and can see them enjoy the proceeds of that. That is really important. Like, I don't want to be dead and know that my kids have got are financially safe. I want to know that now. I want to see them grow with their families and be able to help them through that. I haven't got any money to give to my kids. I spend it all. Shane will be really. We've got Netflix subscriptions. There are things that you've got to talk about in those conversations as well. Retirement is so far away. I've got so much time. I am 52 years old this year. When I was 21, I used to think to myself, superannuation, what a load of garbage. That is something you need to think about. It comes around really quickly. Like, you might think you've got ages and ages, and you have, but it does come around really quickly. So think about, you don't need to plan it all out dot by dot by dot right now, but you do need to have a plan of what you want to do with things in the future. Shane and I sat down with Peter about 4 years ago and we talked about what our legacy looked like. It's really important to think about things in that respect as well. What do you want your legacy to look like when you are planning for the future? Do you want to be giving money to charities? Do you want to be supporting different organizations as you grow older and things like that? They're all questions that you should, have in your plan, because there will be circumstances along the way that will make you think differently. You might come across someone who you really want to support and they have a charity or a not-for-profit that they are, building, and you might want to support them, and you've got to think about those things as you go along as well, because it's important to live life and understand what you want to achieve with it. There are so many things on that slide. You're going to get a copy of the slide as well as access to more information.
I'll just reiterate one thing though. So you can only access super from the age of 60. So before that, if you're lucky enough to retire before the age of 60, you still cannot access your superannuation until the age of 60. That's the first date, critical date, and there's no guarantees that's not going to change. As we get old, we're living longer. So that used to be 55, then they changed it to 60. Wouldn't surprise me at some point in the near future they then recalibrate that to increase it to 65. But that's the minimum point when you can access super. If you're still working, you can access super from the age of 65. But 60 is that critical date, so you've got to always factor that in. So I've got a client who's in the fortunate position who they're going to retire at the age of 55, but a lot of their money's in super. So they've got to make sure they've got the cash flow outside of super to actually retire. So they've got to make sure their investments are giving that cash flow that they need to be able to support themselves between that 5-year gap before they can start tapping into their superannuation.
Pre-marriage musts for the people in the room who are not yet married or who are planning on getting married again. Congratulations, Lisa. Conversations to have when you're considering marriage or life partnership, they're all up here on the space, but it's really important to understand that open and honest conversations are the key to all of this. It's not about, you can plan all of these things. You've got to have an open and honest conversation with your partner about what you would like to do. But there are some key documents that need to be updated as a result of marriage. So there may not be tax implications to getting married, but there are certainly other implications to getting married. Some of them are on here at the moment, and Shane's going to talk about superannuation beneficiaries from more than just a pre-marriage must situation, because that's a really important one. Wills and estate plans, powers of attorney and insurance policies all need to be looked at as part of your marriage preparations. You need to be across all of that and make sure that the things are changed when they need to be changed. You may think that, I'm getting married and all of that just overwrites everything that you've already done in the past. That's not always the case. So it's important to have a think about those things. In respect of wills and estate plans, you may think I'm too young to worry about a will and estate. At the conference that I went to for Mel Brown late last year, she had a speaker on stage who had lost her husband when she was 17 weeks pregnant at the age of 25. They had talked about getting wills done before they got married and they never did them. And she talks very much about the process behind that as a result of them not having wills in place. It's really important. We have a conversation with all of our clients around their children getting wills written at the age of 18. We actually have a conversation where one of our directors used to say that you should gift your children a will at the age of 18. You should start talking to them about it straight away. So if you are in this room and you do not currently have a will in place, give some thought to it, because it's a really important document. Shane, talk about superannuation beneficiary.
Okay, so superannuation. So your superannuation fund, does anyone know about your nominated beneficiary of your superannuation fund? Does everyone know their nominated beneficiary? They do? Excellent. Because if you don't, you need to work it out, because depending on where your money is, superannuation is not covered under your will unless you make a nomination under your superannuation beneficiary nomination to nominate your legal personal representative, which means it forms part of your will. If you don't have a nomination, then it's up to the trustee of the super fund, whether that's Aware or Australian Super or someone else, to make a decision about where your money goes. Now, they would invariably do the right thing and allocate it to a family member, but that might not be the right family member for you, subject to your circumstances. So it's really important that everyone checks their nominated beneficiary. And if your circumstances change through marriage, through divorce, or otherwise, it's really important that you look at that to make sure that your superannuation is going to the person that you nominate.
Who can be your nominated beneficiary?
It can be a family member, so it can be your spouse, your de facto. It can be your children, but there's very strict rules in terms of who is a beneficiary for superannuation purposes. So it's generally a lineal descendant of yours. If you don't have a lineal descendant, then you nominate your legal personal representative, your LPR. And Peter, pull me up if I'm saying anything wrong here. Thank you. That's my bush lawyer coming into it, but sometimes I get it wrong. You nominate your LPR, then it'll form part of your will, and therefore it's an asset that gets dealt with under your estate. But then it comes down to who you've nominated in your will. If you don't have a will, that's problematic too. So they really work hand in hand, the two documents. And then on top of that, you've got powers of attorney. So what if I'm incapacitated and I can't make decisions for myself?
Can I want to talk about powers of attorney because it's going to impact on people in this room, because I know some people are going overseas and they're young people this year. If you do not have a power of attorney in place that even covers your parents if you are a single person and you are overseas and your bank account gets locked, your mum or dad cannot help you with that bank account. You have to deal with it yourself. I'm looking at you, Alana. I would recommend that.
That's okay. The parents will just give out money.
Yeah. Your parents will look after you, but you know. Before our daughter Emily went overseas for a period of 12 months on university exchange, we made her sit down with our legal team and update her powers of attorney so that if anything happened to her while she was away, we had the ability to access all of her accounts and all of that sort of stuff while she was away, so we could make sure that we were doing what we needed to. It's a really important thing to be across, whether you're entering marriage or whether you are just, you know, in any circumstance. You want to be able to give the ability for your parents, your spouse, your whatever, to work on things in your place if you're not able to. And that's one thing where, you know, if you need to go and apply for a new passport and you need a birth certificate and all of that sort of stuff, you want to be able to have that covered. Young people often don't think to themselves, I need to worry about power of attorney. You think about it as a, who's going to look after me if I'm medically incapacitated? It's not always that. Sometimes it's just that you're not in the country. And you need to be able to do it.
Powers of attorney are only valid while you're alive. So that's the other part too. So when you pass away, the power of attorney becomes redundant, and then it comes down to your will and how your estate is managed. So so that's an important note. Then insurance policies. Yes. So if you're running a business, and this is a really important one. So if you're running a business and you might be a director of a company that you're running the business through, and you're the sole director of that company. If you become incapacitated, then we've got no director who's actually can step in and run the company. So we normally do what's called a corporate power of attorney, which nominates someone to take your place if you're incapacitated, so they can then continue on with the business and still manage it while you're unable to do that yourself. Or same deal, if you're overseas and there's documents that need to be signed and it can't be signed electronically or otherwise, then nominating someone who's in Australia to sign those documents as the corporate power of attorney is an important thing to consider as well. Yeah. And we have a number of clients who have sole directors of companies because of asset protection and other things, but it can be complicated if you're incapacitated. And also looking at structures, companies and so on, and if you've particularly got trusts, they may not be covered under your will either. So if you've got assets in a family trust, as an example, then that family trust survives you, and so does a company, and therefore it's important that when you're doing your will that you're looking at who takes over control of those entities to ensure that they're directed to the right people. So when you've got businesses and you're running through structures or have structures, it's really critical to get proper advice on estate planning so that you know that if something does happen, everything will be handled in an effective way for you. With insurance policies, that's income protection insurance, life insurance, things like that. Same situation, life insurance, you've got a nominated beneficiary, so make sure that's the right person. If you've gone through a divorce, some people forget to update their nomination. So then if you pass, then it might be the former spouse gets your life insurance proceeds. So just make sure you're diligent on those things. If there's a life event or a change in your circumstances, I always suggest that if you've got a will, it doesn't sit in the drawer forever. You pick it up every couple of years and have a read of it just to make sure it's relevant and the people you've nominated to act in certain capacities are the right people still. So it's not a set and forget. Yep.
Recurring calendar reminder.
Yeah, absolutely. Absolutely. Yep. Yeah, definitely. Yep. Yes.
Question back to superannuation beneficiaries. What about binding nominations?
Yeah, good.
That's a
Yeah,
big deal, isn't
it
it?
is a big deal. So you can have what's called a binding or a non-binding nomination. So the way it works, if it's a binding nomination, that means then the super fund trustees who manage the super on your behalf have to follow your wishes. And Peter, pull me up if there's anything that might change. But basically, a binding one means they have to follow your wishes. If it's non-binding, they will generally follow your wishes, but they're not compelled to. So non-binding means that it's just a guidance. They generally will follow, but it's not binding. The other part too, with particularly funds like Aware and others, and don't hold me to the actual specific funds because they're all different. Some of them have lapsing or non-lapsing nominations too. So some lapse after 3 years. So after 3 years, that nomination is no longer valid. So you've then got to renew it again. So you got to binding versus non-binding, and then lapsing versus non-lapsing are really critical things you need to be across with your superannuation entitlements, and making sure that you've got the right person in all those elements and making sure they're not expiring because of the structure of that super fund. Yep.
Find all of that in your whatever online login
Yep,
that you have for your super. It's all under your account information.
Yep.
You can change it all in there.
Yeah, and every super fund's different. They all have a trustee, which is their governing rules, and each fund is different. So what might be the case for CBUS will be different to Host Plus versus what you might have at Colonial versus wherever else might be. So it's really important that you're across these things. And so part of your financial literacy is to make sure you've got the right nominations in this respect, and then also making sure you've got these key documents in place and you've got the right nominations within those key documents.
So this is just a reminder slide, all the different things that you should be across. There are more than these things, but these are the things that are, top things to be across for yourself. Your will and estate plan, clearly outlining your wishes, testamentary trust. I'm not even going to talk about that because that's the complex area, and I want to make sure everyone gets a drink and something to eat. You can ask questions of Peter or Shane about those things afterwards if there's something there that is of interest. Your superannuation and beneficiary nominations, head home this weekend and open up your super app and make sure that those things say what you wish them to say. There will be young people in this room who have never looked at that before. It's not something that you're going to be necessarily reminded of by your super fund either. So they will not send you a text message saying your your net death nomination has lapsed. Yeah. We know that because we've seen people with lapsed nominations, haven't we, guys? So it doesn't happen.
And also with that too, insurance, generally most funds will provide you with a level of cover of insurance, might be 50,000 life or otherwise. So check if you've actually got life insurance or not within your fund. Yeah. Most likely you will, and therefore it's important that you've got that nomination in place.
Yeah.
Multiple super funds.
Yes.
Yeah. Consolidation, possibly. Yeah.
2 sets of fees. So consolidating into one, like if you have one automatically set up in your hospitality job and then a different one set up over here, combining those can be helpful.
Yeah.
And you can go onto your MyGov account, and in your MyGov account online, you can then click on the superannuation tab and you can see what funds you've actually got in there. And you can also check the lost super. If you think, gee, I thought I had some super from this time, there's a lost super tab you can go into and try and locate your lost superannuation as well. And you might be surprised there might be a little bit of a nugget there because of the compounding interest and everything, that you might have some lost super that you didn't know about that's got a little bit of balance in it that you can then move into your nominated super fund that you're managing.
Yep. Insurance, make sure that you've got at least considered income protection insurance, particularly if you have a mortgage, because nobody else is going to pay your mortgage if you can't work. So you've got to think about that sort of stuff. It's not something that you can just go, oh, that won't happen to me, because it might happen to you. So think about it. It's also, insurance is not a set and forget thing either. Make sure that you are across the coverage that you have if you've got insurance, even if you're health insurance. Like, don't just go, oh, whatever, and think, because it just comes out of your bank account monthly. It's super easy to just forget about what that policy entails, and calling your health insurance fund every so often and saying, have I got the best possible policy for my individual circumstances, is a really important thing to do. And it's something that we often forget about because it actually just does come out of our account monthly, and they bank on us not actually being across that cover being appropriate.
For some people as well, for anyone in terms of factoring in children and cash flow and health insurance around that, most health insurance funds require you to have 12 months coverage for pregnancy and birth. If you would like to go down the private health route for pregnancy and birth, you need to have that on your health insurance coverage for 12 months before you get pregnant. So don't start planning for a family and go, oh, now I'll turn it
Upgrade
on. It needs to be there for 12 months for a lot of funds. So just check that as well.
Yeah.
And last with these too, with the income protection insurance, life insurance, etc. If it's not paid for within your superannuation fund, you've got a separate policy that you've organised yourself. Have that reviewed regularly. Test the market, because premiums have jumped quite dramatically in the last few years because of additional claims and so on. But the market's recently got more competitive, and there's some savings you can have on that. Even personally, I've done a review with James on my insurance, and my insurance is halved.
Wow.
Yep. Because we went to another provider, same terms and everything. It's just that the market's more competitive, and I was a bit lazy with it and didn't test the market. And that's what's happened. So I'm saving half what I was paying previously. So even if it's just a review to see whether you've got the best product or not, that can be done. We, again, not trying to sell, but we do that as a no obligation free option for you, for us to just see compare yours to the market. And then you can make a decision about whether you want to keep that or not. And invariably, sometimes they say, no, got the best cover, don't change it. Yep.
What happens if things don't work out? We won't cover all of this in great detail today, but life happens. So we need to be across the fact that sometimes we don't get the outcome that we hoped for originally in all sorts of circumstances. So it's really important that if those things happen, that you seek out advice. Make sure that you have got a good family lawyer to be able to manage those things for you and have a conversation with. Again, we do not do family law here, but we have access to some incredible people. And actually, Lisa has given me the names of, 5 or 10 amazing family lawyers out there who really do a wonderful job looking after women in circumstances where they need advice on this sort of stuff. So make sure that you are aware. That's all that you need to do. And we all know that divorce and separation does actually bring out the worst in people. So we've got to look after each other. So if you have a friend who is going through a breakup or a divorce situation, reach out to them and just tell them that you're there for them and you can provide support, because it is a super hard time for people to go through. And often it's a really isolating place to be as well.
Can I just
Yep,
just want to
of course you
add, and give a couple of recent experiences. We've done a bit of work for a couple of women who have been going through marriage breakdowns where their husbands have been running substantial businesses with multiple companies and structures. And one of the challenges with these things is trying to get the information to work out where things are. And invariably there's gaps because they're not disclosing the information that we need to be able to then determine what the true asset position is. And unfortunately, they'll invariably try and hide things. So this is part of the process. If you've got a partner who's running a business and they've got business operations or whatever it might be, you've got to, so I was going to say inappropriate, I was going to say shit hits the fan, sorry, apologies. But before things go sour in relationship, not that anyone's planning to do that, but while things are good, you've got to understand what's going on with that structure and where things are. Because when you get to that end game of a marriage breakdown, and Alana and I can attest to this with a couple of recent experiences, such gaps, we couldn't get financial information for the last 2 years for one of them. They could have done whatever they liked in the last 2 years to move assets or whatever else. So it's really important that you understand the circumstances of your partner's business, if they've got one, and how the assets are structured. So education is really critical. Keep asking questions. Yeah.
In our experience, the amount of meetings that happen with Shane or one of our advisors in our office that do not involve the partner of the person who is in it is high. it is a really high percentage. So this sort of session is about just reminding you not to be part of that percentage. Take an active seat at the table, even if it's not a business that you're involved in or necessarily fully across or aware of. Be at that table to understand the implication of it on you from a family perspective. Because if you are taking time out of your career so that you can look after children as your partner is building a business and a career, it's really important that you understand that you are enabling that for him. You are him, I say him, but it could be her. You're enabling that. You are the support person. You're the one who is bringing up the family and going to school events and all of that so that your partner can be in the position that they are in, and you deserve to have a seat at that table as a result of that. So,
and in addition to that, if something happens to them, you might need to step in on their behalf,
which we've also seen.
And if you don't know what's going on, that's extraordinarily hard. And then you have to seek advice from accountants and lawyers and everything else. Then the costs and everything go with that. So again, that education piece, if heaven forbid something happens to your partner, being able to step in and be able to manage the structures or the business or whatever it might be is really critical, because you've got to make decisions about that. Yep.
So send across some case studies to you so that you can have a look at these sorts of things. Different age groups, different life situations, different goals. It's all about making sure that you're across what your goals are. These things are, ideas for you to take home with you. Put yourself in that place depending on how old you are in these case studies. And, if you're 35, these are the sorts of things that you might be thinking of. If you're 47, et cetera, et cetera. So just put, cross out the generic name, pop your name in there and work forward with it. But using main goals, super investing and protection as the things that you think about when you're looking for your plan ahead. We have lots of real life actual case studies if you want to talk about those sorts of things from a redacted point of view. We have seen everything. And Chelsea's put together this fantastic slide with quick wins, 3 things that you can do this weekend. Log into your super and check your superannuation balance and check your beneficiary nominations. That's a really simple one that you can do. Set up or add to a personal emergency fund or savings account if you've got something that you are planning towards, an overseas holiday, a wedding, something for yourself, a fancy bag. I love the idea of buying a bag. I don't know why I've never bought an expensive bag in my life. I just love the idea of it. Book a strategy session or a financial health check. Aintree Group does free financial health checks. If there's a link on our website, which Chelsea will send to you, but so many organisations do it. You don't have to come to us. I'd love it if you did, but you don't have to come to us, and happy to share with you all of the different details on
one extra one, just so I talked about interest rates at the start.
Oh yeah, so check you.
Our interest rate is 5.54%, 5.54, which is pretty good. So compare yours to that. And then don't be afraid to go to your bank and say, look, someone else, I can get 5.54 from someone else if yours is higher than that. Just see what happens.
Yep.
You might be surprised. Or they might say, look, we can't, if yours is higher than that, we can't bring it down to that. We might be able to bring it down to this figure. That's a win. So that's another thing you can do on top of those ones we just talked about.
Yeah, absolutely. As I said, seek out advice. That is the biggest thing that I can give you out of this day, is to seek out advice. Do not be scared. Do not be, don't think that you are unworthy of coming to see a financial advisor on your own. Even if you're in a partnership, there is no reason why you shouldn't have your own financial advisor or your own financial plan. Just open those conversations with yourself and be comfortable and confident to take those moves for yourself. Thank you. We could talk forever. We could literally go all afternoon.
I know that we said that we'd wrap up around 1:30, so you guys have timed that perfectly, by the way. But that doesn't mean that everyone is immediately has to rush off. If you would like to stay and chat and ask questions, please do. There's obviously still plenty of food and drinks at the back, so please do hang around, network amongst yourselves. We've got some fantastic people in the room as well as our Aintree team. We've got wonderful advisors that you might want to connect with as well in the room. But thank you so much, Andrew and Shane. We really appreciate you sharing your insight with everyone today. It's a really, really valuable discussion, and we hope you've all taken away at least one thing, even if it's not for you. It could be for your daughter or your mom or your friend. And just thank you so much for being part of the conversation. Like Andrea said, we'll send these slides. We've got the free financial health check, and I will make sure that Ray's and Roller in the email that I send out. But thank you all so much for coming. We really appreciate it.